Hey guys, welcome back to the channel. Today I wanted to ask the question, is the strategy of investing in the S&P 500 broken now? So I think, you know, we sort of have this idea that investing in US equities, especially the S&P 500, is sort of like the best bet. And for a lot of reasons it is. At least from a philosophical standpoint, you're investing in 500 different companies, which is a diversified basket of stocks. You're also investing in the U.S. equity market, which is traditionally a very strong market. And by investing in a passive ETF, you're saving on fees. These are all really great reasons to invest in the S&P 500. But recently, I've started to think about why some of these reasons are starting to not hold true anymore. And sort of what the breakdown in the investment solely in the S&P 500, why that's happening. Famously, I think we heard Warren Buffett make the bet against hedge funds that they couldn't outperform the S&P 500 over a long period of time, so 10 years. And traditionally, he recommends investing in just an S&P 500 and maybe having some bond fund. But as I sort of dived into what's going on with the S&P 500 in general, I think it's sort of raised a few red flags for me, or cautionary sort of signs. And so what I wanted to look at were a few reasons why I think going forward, it'll be better to diversify more broadly from the S&P 500 and where you can go to sort of make those strategic investments. So it's going to be really hard at this moment to convince people that the S&P 500 is not a great investment. But I think the recent performance has been so staggering that it's really hard to say oh, you shouldn't invest in that. Because over the past 10 to 15 years, the S&P 500 has driven huge returns. And that's largely because it's been invested in these really big tech companies, which have just done incredibly well. Especially as we've seen AI grow, we're seeing these big companies grow exponentially, especially above all the smaller companies. So the question is this sustainable? Are we going to be able to continue this momentum into the future? I mean, after we've had such stellar years of returns. I think I want to start by debunking one idea about the S&P 500, and that is that you're actually investing in 500 companies. Technically, it's true you are, but if you look at their holdings, you can see that you're basically invested in 9 companies that represent 35% of your portfolio. And so the question is, are you really diversified when 35% of your investments are in these 9 companies? You get to 50% allocation with under 30 companies. So really, if you're thinking about this, S&P 500 is sort of the 500 in that is sort of a misnomer because you're so heavily concentrated in just the top companies. And so are you really receiving proper diversification? There's so much concentration risk, especially with companies that have just done so well. And there's so much valuation baked into that future performance that if something changes, if sentiment changes, you're going to see a huge hit to your portfolio. So it's not really the American economy that you're betting on. You're not really betting on all US equities. You're betting on these really big tech giants and these really big mega cap companies that are deriving value from a lot of technology. So, any sort of regulatory changes, AI disruption, any kind of big hits to any one of these companies could really drag down the portfolio. So first off, there's just this big concentration risk. You don't really get diversification from just buying the S&P 500. Secondly, I would say that there's this argument that there's a sort of a passive investing feedback loop that's happening. And so, more people especially with the rise of these like no commission brokerage firms like Robinhood, but basically all the investment firms allow you to trade ETFs pretty freely. People can just pour money into these ETFs. And on top of that, you have all these institutional investors and retirement accounts that set these passive ETFs as part of your investing strategy. So you're just going to have funds flow into these, especially these S&P 500 ETFs. And so what that does is it just basically says, all this money flows into these ETFs, and then by virtue of the money flowing in, they have to invest that money into these S&P 500 companies. And largely that's going to be concentrated in these top 30 companies, right? So you're basically just pouring money into it, and that pumps up the valuations of these top companies, not because there's necessarily like optimism around their valuations or around sort of like future growth, but just because money is flowing in. So it basically is just self-reinforcing. It's not saying anything about how valuable those companies are or whether the valuations are, good. It's just saying that because people have to invest, and because, through their retirement accounts, because we know investing is important, people just push money into those very popular ETFs. They're basically going to just pump the valuations up. And so, I think we can see that even on the stock level, people just pour money into specific stocks because they know that they're doing well, and because like these investment managers have to allocate money according to their philosophy. So if money pours in, they have to invest it. They can't leave it in cash, because their goal is to fulfill whatever promise they made. So if it's an S&P 500 or even like a NASDAQ 100, like they by definition have to invest that money. So that's just going to go into these top stocks. The other idea is that there might be some rotational change, right? US equities have just been doing so well for so long. Things don't just always go straight up, right? You're gonna have years, and of course, like, the last 10 to 15 years, it feels like US equities have just been always outperforming, but there have been down years, and years where like international equities have done better. It's just that the years that have way outperformed have been so strong that people forget that there were down years. So rotation will happen. People will rotate back into value stocks or small and mid cap stocks or international stocks. So that's another consideration. Just that because we're coming off a really strong S&P 500 performance, we forget that there can be rotations away from that. So what can you do to just make sure that you actually have a diversified portfolio? Again, it's important to diversify away from sort of market cap weighting. So right now the S&P 500 is so concentrated in these mega cap stocks that you want to make sure that you're balancing that out with small and mid cap stocks. You can certainly do an equal weighted index, so it doesn't overweight the top stocks. It kind of equal weights each of the stocks within these index funds. You can do sort of fundamental weighting. You can move towards, again, to emerging markets, multi-factor ETFs. Just diversify away from just these mega cap stocks. I've sort of done I think diversifying across different assets that have lower correlations to the US market and to these mega cap stocks is also important. So, you can talk about hedging assets, inflation protection, like gold. You can talk about energy, commodities, resources. Those are other places to place your money. You can definitely talk about being more valuation conscious. So like looking and making sure that we're looking at value versus these growth stocks. So a lot of, obviously, the S&P 500 has been driven by these huge growth stocks in tech, but you can start to pull back and bring in a lot of value stocks. These might not have performed that well in the last 10 years, but going forward, they will provide your portfolio at least diversification during downturns. Obviously, there's so much anticipation and value baked into what people are believing in AI. So there's so much future growth that's already baked into the valuation of these tech companies that we have to be aware of that. And so, the last thing to think about is just like make sure you're setting your targets and sticking to those and then rebalancing to them. So, if you decided that your US equity portion, um, or if you want some amount in mega caps or whatever, if you said that at some percentage and it's grown past that, you have to be diligent about bringing it back to your targets. I know it seems like you're like, oh, but this has been growing so much, I can't just like cut it back. At this point, being disciplined will help you in the long run. And so then you reallocate that money to underperforming stocks, at least relative to the high tech stocks that you had. I mean, this doesn't always mean selling stocks. It could be just means as you are investing more money, as you have cash that's becoming investments, you can just invest in those underperforming stocks instead. So what are like some key considerations to what might drive down the performance of the S&P 500? Well, we've already been seeing that there's been a lot of regulatory crackdowns. I think there's been a lot of talk of Alphabet, Google, being broken up. We can see like a lot of monopolies forming around the consolidation of wealth around in these big mega corporations. They just become monopolies and they grow and grow and grow. And so that's going to lead to some regulation against them. I think that as mega cap companies continue to grow, you'll see the government stepping in to break them up. And that will drive down valuations for those companies. Obviously, also, we've seen a lot of geopolitical instability with various wars around the world. That could lead to a lot of supply chain disruption, market disruption. And so that's something to be aware of. These companies are multinational. Their supply chains are very sophisticated, but they operate all around the world. So they're far more prone to geopolitical changes because they operate all over the world, as opposed to someone who's like localized. And then if interest rates change, I think another thing that could happen is that can really affect these big companies that are leveraged and rely on debt. It can change their sort of the valuation metrics that we use to value these companies. So all in, I think the S&P 500 has been doing very well, and we'll probably forget that it did have downturns too. But nothing keeps going up into the right forever. There will be moments of pullback, and so in those moments, you want to make sure that you have other assets that work for you, and then those are opportunities to rebalance. So again, if you're just invested if half of your portfolio really is just like 30 companies, 25 companies, like, are you properly diversified? And I think the answer is probably no. And so, yes, you may give up some upside if the S&P 500 runs up like crazy again, but you'll be protected on the downside. And there are various strategies that can really help your portfolio during those moments. So I hope this was helpful. I would just advise everyone to stay diversified, and remember that S&P 500 is probably not proper enough diversification.